Good morning, everyone. Welcome to another episode of the Mizuho Week Ahead. I'm Jingwen, market economist at Mizuho Bank. This week's theme is Fragile Ceasefire. After weeks of escalation, the US-Iran ceasefire last week sent oil prices plunging to below $100 per barrel. However, the relief was short-lived, with US and Iran failing to reach a deal in direct talks in Pakistan over the weekend, and US President Trump signaling a naval blockade of the strait. Oil prices are set to trade higher this week. Meanwhile, US data last week was mixed. ISM services reflected stagflation risks, while a contraction in personal income implies strained budgets. These cross-currents were reflected in March FOMC meeting minutes, with some members indicating a strong case for a two-sided description of the committee's future interest rate decisions. Inflation prints and expectations also came in higher. The acceleration of the US CPI print in March was largely within expectations, but the subdued core inflation print will keep the Fed on hold, though they may be much more cautious in labeling the situation as transitory due to a one-off effect from the rollback of tariffs for some components. The University of Michigan survey showed a sharp rise in near-term inflation expectations in April, although longer-term inflation expectations remain rather anchored. Given the tight correlation with gasoline prices, near-term inflation expectations may remain elevated as the geopolitical situation showed little signs of improving. The same energy shock is reshaping central bank policy more broadly and inciting divergent views. In Europe, ECB Wunsch warned that a prolonged conflict could necessitate a series of rate hikes. Notably, he also highlighted a possible hike that could be undone subsequently. In Japan, expectations may be building toward an end April hike, with data indicating positive manufacturing sentiments and tight labor conditions. That said, a rate hike is certainly not a done deal, as a further release of 20 days of oil stockpiles reflect real economic stresses. Across Asia, higher energy prices reverberated in inflation data. Philippines and Vietnam headline CPI surprised to the upside, with energy-linked items as key drivers, while Thailand and Taiwan's prints surprised to the downside, reflecting government buffers via fewer price caps and cushioning measures. Both RBI and BOK held rates last week, as both central banks are cautious about dampening growth when inflation data has not yet justified a shift towards tightening. For the week ahead, markets will be focused on the US-Iran conflict. With Iran being a key supplier of crude oil to China, the US blockade will likely prolong China's ban on refined petroleum products exports. The likes of the Philippines, which import 30% of their petroleum products from China, will be hard hit. Even energy producers such as Malaysia, who source 15% of their refined product needs from China, will face issues. EM Asia FX will start the week on the back foot as energy vulnerabilities take center stage. In Singapore, MAS is expected to tighten with a double-barreled move, recentering the Sing dollar near midpoint upwards and steepening the slope to front-load the dampening of imported inflation. Malaysia's Q1 GDP is expected to print above 5%, though the moderation of growth momentum in subsequent quarters will keep B&M on hold. All in, the ceasefire has bought time but not resolution. Until traffic flows freely through Hormuz, the inflation, fiscal, and FX pressures on EM Asia remain very much alive. For more information, please refer to our Week Ahead publication or contact your respective sales desks and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you.